Welcome to the Capital News. I am your host, Alex Karitis. Thanks for joining me today, February 21st, 2019. Let's get straight to some economic news. The S&P was down 10 points. The Dow was down 104. NASDAQ down 29. And the Russell 2000, the small cap index, was down 6 points. Oil, gold, and the silver markets were down on a seemingly stronger U.S. dollar. Gold has pretty much given back its recent strong gains, as has silver. And the oil market continues in the U.S. to hit production targets and records. So despite the OPEC and Russian cuts in oil, U.S. oil sector is continuing to pump that black gold out at a record pace, and we have inventory levels that are continuing to increase. Now, this becomes interesting because, as we'll get to later here today, the economic news around the world is not great. Some may say it's not even good. That would be me. I don't think it's that good. So when you're looking at the price of oil, you have four pretty much main components that one would want to look at sort of right off the bat. Obviously, supply and demand being two. Then you would want to look at the strength of the U.S. dollar because oil is traded in dollars. And then you want to look at geopolitical risks. Well, we have a slowing global economy, so that should not bode well for demand. Now, we have oil giants such as OPEC and Russia wanting to do cuts, production cuts, so you have that slowing down. But is it enough to overcome the slowing demand? Because obviously here in the United States, our energy companies are just pumping it out at record levels. Now, the dollar is going back and forth as to whether or not it's strong or it's weak. It really depends on the news of the day. So that's driven. And then you have the geopolitical events that are taking place around the world. Of course, it continues to be a slower demand picture globally. You have the shenanigans going on down south in Venezuela, which is another oil giant. So if that can get situated and Venezuela can really start to pump their oil back out onto the market, especially if the U.S. has a big say-so in what happens down there. And believe you me, this is American empire at work. Anywhere there's oil, we're going. Don't kid yourself. We stay out of Russia because Russia has nukes. But we'll go into Iraq, we'll go into Libya, we'll deal with the Saudis, and we'll go into Venezuela. I mean, Trump saw an opportunity, he's taking it. He wants to install Guaido. Like I've said before on other podcasts, let's install Senator Marco Rubio and make him El Presidente of Venezuela. I think that would be fantastic. He wants to be a president of a country. Let's make him president, El Presidente of Venezuela. Let's get him to increase production down there. And we can have gasoline for, 10 cents a gallon. I mean, why waste any time? Let's make it happen. Let's make America great again, and let's make Venezuela great again. Two birds, one stone. Why stop? I don't think that'll happen, but I'm just saying, I'm throwing it out there. Let me know what you think. Now, as far as the U.S. markets are concerned, being down 100 points today, given the news that came out today, I'm surprised it's only down 100 points because we just experienced a fourth quarter of 2018 where we saw stocks hit correction territory and bear market territory, thinking that a lot of the news that broke today was going to happen, was going to take place, that there was going to be an economic slowdown. So stocks, being the forward-looking entities that they are, sold off. And they sold off to a degree that put them in bear market territory. Okay. And then, of course, policymakers come in and they say, you misunderstood us. The Fed did a 180 policy turn. And they said, no, everything's fine. We're here to backstop the markets. Don't concern yourself with what we said before. Increasing interest rates. Our balance sheet is on autopilot to run off. Didn't mean it. Did their damage control. And then the markets have been rallying for 8 straight weeks. 8 straight weeks. If you remember, because it wasn't that long ago, Apple came out and gave forward guidance before they released their earnings. And they said it's not going to be good. It's just not going to be good. iPhone sales, don't expect them to be good in China. And in fact, we're not going to tell you how many iPhones we're selling anymore. We're just not going to give you that number. That's not a good sign, ladies and gentlemen. That's their meat and potato product. And they don't want to tell the public, their shareholders, how many of these things they're selling, and that their sales are declining in China. The market, if I remember correctly, sold off about 600 points that day. 600 points from one company. One company moved the market 600 points. Then I believe it was the very next day that we had a very strong unemployment number, an unemployment report. And then we had the Federal Reserve come out and do its 180 policy U-turn. So the markets skyrocketed. I think it was 800 points. So it completely negated Apple's news and the 600-point drop-off in the Dow. It blows my mind. It's crazy. You have a company that comes out, and a large company that has a global reach. Things are slowing down. Drop 600 points. Okay, that makes sense. Maybe it was too much, but nevertheless, at least it's in the right direction. Then you have an employment report that beats, and a Fed chairman that comes out and says, we're reversing course, or we're going to be a wait and see. We're just going to see what happens now. And it rallies 800 points. That was most definitely unfounded. But of course, in this market where you have the stock market acting as a drug addict, as a junkie, and the Fed serving as the dealer, well, the junkie got his fix. So I guess he got high again, and so when it makes an 800-point rally in one day, when you look at it through that lens, it makes a whole lot more sense, doesn't it? But let me get to some of this news that broke today. Some of it's mixed, some of it's not so good. But for the Dow to only be down 100 points, there is most definitely somebody who is backstopping these markets. We know for certain that it's the Fed on one of them. And if you look at other central banks around the world, if you look at their balance sheets and if you look at what they're doing, they're backstopping the markets too. This is a global coordinated event. And it has really been a global coordinated event for the past decade. I'm simply of the mindset, and I tell you guys this all the time, that it's running out of juice. Diminishing marginal returns has got to kick in sometime. They had a good run. They gave it a good try. It's been 10 years. It's going to start to unravel, and it ain't going to be pretty. But here's some news. Here's an article from MarketWatch. U.S. manufacturing PMI slumps to a 17-month low, while services picks up. Australia, Japan, and Germany see manufacturing PMIs below 50. A reading of U.S. manufacturing sentiment fell in February to the lowest level in 17 months, another sign of the declining momentum in the industrial sector. The flash reading of the IHS Market Manufacturing Purchasing Managers Index fell to 53.7. 53.7 from 54.9 in January, on a scale where any reading above 50 indicates improving conditions. So, despite the fact that February's reading is 1.2 points below January's reading, it is still above 50, which does indicate an expansion in economic conditions. So that's at least the good news out of this. It's not good that it's declining and getting closer to 50 or below 50, but at least we are north of 50. But a separate reading by IHS Markit of the services industry saw improvement, rising to an 8-month high of 56.2. So there's seemingly a divergence, at least in this month's data, between the manufacturing sector and the services sector. Now, we're constantly told that those in the manufacturing industry, that's sort of the bread and potatoes of everything, meat and potatoes of everything, those are the people that make the bigger salaries. If you're in the services industry, you're making less. So what does this mean? What does this mean for the consumer? How strong is the consumer then? Are we going to see more layoffs in the manufacturing sector? Now, we're not quite there yet. We are still north of 50. So as long as we're still north of 50, that's still in the right direction. Going down month to month is the wrong direction. So if people with good paying jobs start to lose their jobs, they start to get laid off, that's not going to bode well for consumer spending. Okay, that's not rocket science, that's just how it works. Across the globe, other manufacturing PMI readings were generally weak, including from Australia, which is particularly sensitive to Chinese demand. And here we have a list provided for some of those numbers as well. So if we look at Australia, they are at 49.7, which is a month-over-month decrease of 1.6 points. Japan, as I had stated yesterday, is down at 48.5. France is up a hair, 51.4. Germany is down 2.1 points, 47.6. And then obviously the U.S. is at 53.7. So spin the globe, go around the world, it's not the best it could be. We are slowing down. Let's embrace it. Let's be adults about it. Call your politicians out to be realistic and honest with you about this. We are in a political campaign, the 2020 election. If you're going to go out there and talk in a town hall to Senator Kamala Harris, Bernie Sanders, Elizabeth Warren, Cory Booker, ask some serious questions. Get out there and ask some serious questions about this stuff. Because we're constantly told that this is the best economy ever, that the best deals ever are being made, that we have $22 trillion in debt. How is this going to be taken care of? What's your plan to take care of the debt? Do you even care that we have $22 trillion in debt? Does that mean anything to you? Can somebody please ask those questions instead of saying, well, how are you going to pay for my health care? I mean, these are some of the questions you get. Just turn on the news, and when you watch some of these town halls or when they're just in a coffee shop and there's a camera and a microphone on, these are some of the questions they get. How are you going to pay for my health care? How is that question even being asked in this country? It's not the job of the President of the United States to pay for your health insurance, your medical care. Am I wrong? No, I'm not. And I'm unapologetic to it, too, because that's not how this country operates. This is why we have $22 trillion in debt. Because politicians who want to be president, they scratch their head and they say, oh, all these people are asking, how are you going to pay for all this stuff? Well, maybe if I say it's going to be free or if it's going to be really inexpensive, they'll vote for me. And they do. They sucker them in. And then they vote for Social Security. And they vote for Medicare and Medicaid. And now they want to put everything else under the sun. And how are they going to pay for it? Well, let's just tax the millionaires. Until they realize, very shortly after, that there aren't enough millionaires to tax. And then we're in $22 trillion in debt and rising. Why is it said that we have a strong economy and we have $22 trillion in debt? We have trillion-dollar yearly deficits, and we have interest rates that would indicate we're in a recession or in a downturn. Can you answer those questions? If you can answer those questions, then maybe you're qualified to be the president because then you have some sort of economic understanding of what's going on. Ask them. I would love to hear their answers because nobody talks about it. They just want to blame the other guy. And of course, all fingers are going to be pointed at Donald Trump. regardless of the good things that he has done, and he has done some good things. But one of the things that I think is a big mistake for him politically is to hang his hat on these stock markets and on the economy. I think I've said it before. If I was advising the president, I would say, Mr. Trump, Mr. President, do not hang your presidency on this stock market or the economy. Get out there and be a leader. Get out there and be honest with the American people and say, we have messed up. You sent me here to drain the swamp. That's exactly what I'm going to do. It is not going to be easy. It's going to be dirty. These people are not just going to roll over. Not at all. They have their fingers in a lot of different pies. They have access to $3 or $4 trillion annually to give it to themselves, to give it to their buddies, government contractors who make out. It's not going back to you. It's going to benefit them and their cronies. And everybody knows it. Everybody knows it. Yet we continue to play this game. So get out there and say, I'm here to drain the swamp. I'm here to fix this. And in this process, it's going to get ugly, it's going to get nasty, and it's probably not going to be good for the short term in the stock markets and in the economy. Let's just look at this another way. Say you're somebody who does not exercise. You do drugs, you drink, you smoke, you eat a whole bunch of junk food, you don't take care of yourself, but given all those things, you probably have a pretty good time, don't you? One day you suffer from a heart attack or a stroke. Let's just say it's a heart attack, and now the doctors say, well, you know what, look at this. Here's your record. You drink, you smoke, you do drugs, you don't exercise, you're overweight, got a bad diet, just not doing things right. This is why you suffered a heart attack. Nobody would be surprised by this. Your arteries are clogged up. We got to do bypass surgery. Nobody would be surprised by that outcome either. Well, the doctors are going to go operate. It'll be a successful operation. But you're not going to get up out of bed that day and go run a sprint or a marathon. You're going to be in a lot of pain. There's going to be recovery time. That's what I would suggest that the president does. Be honest about our excess, living beyond our means in this country. Is there a ton of potential in this country to be better and greater than ever before? Hell yeah. No question about it. But we're not going to get there by kicking the can down the road and just being this optimistic, rosy-eyed cheerleader for the United States without looking at reality. I think people would appreciate it. I know I would. I'm tired of being lied to. I'm tired of having people promise one thing after the next. And I'm tired of having people promise things that I don't want, but evidently, because people vote for it, I have to pay for it. So things I don't even want that don't benefit me, I have to pay for. That makes zero sense because I know there's a ton of you out there that are in the same boat. Just simply by definition. That has to be the case. Now, some other poor economic news. Another article from MarketWatch. Philly Fed Manufacturing Index slumps into negative territory in February for the first time in nearly 3 years. The Philadelphia Fed Manufacturing Index in February dropped sharply into negative territory. The index fell to a seasonally adjusted reading of negative 4.1 from 17 in the prior month. Let me say that again. The index fell to a seasonally adjusted reading of negative 4.1 from 17 in the prior month. This is the first negative reading since May of 2016. Any reading below zero indicates worsening conditions, very similar to the PMI that we just went over. Economists polled were expecting a reading of 14. 14 was the expectation, which was still a decline from 17 in the prior month, but we hit negative 4.1. What is going on out there? Can this all be blamed on the U.S.-China trade talks? It might be. Can it all be blamed on the partial government shutdown? It could be. But those are excuses, ladies and gentlemen. Those aren't the reasons for all of this. You don't have these types of drop-offs because of a temporary 30-day government shutdown. You just don't. It's a small blip. I've had conversations with you about this before. Will it show up in some of the GDP numbers? Perhaps. It'll be akin to a hurricane or some other natural disaster. Not good for the people who had to deal with it. Not good for that economy. But for this behemoth of a U.S. economy, as far as GDP is concerned, it's a flea on a dog. It's a little nuisance. Comes and goes. It's not structural. So if anybody wants to hang their hat on that, it's just an excuse for poor numbers. Okay? Now, in other news, this is a Fox Business article. Stocks fell Thursday after the Atlanta Federal Reserve cut its forecast for fourth quarter gross domestic product GDP. The Atlanta Fed's GDP Now, which is a running estimate of real GDP growth, lowered its fourth quarter GDP forecast Thursday to 1.4%. Originally, GDP Now forecast 2.7% GDP growth. 1.4% from 2.7%. They cut it in half. That's a big deal. Now, what's going on here? Is this likely to happen? Is this going to be the real numbers? This is just a forecast. It's just a forecast, mind you. Now, we probably would have had the official GDP numbers come out, but of course we had the partial government shutdown. So those numbers aren't going to be released, I think, until next week, the end of February, if I'm not mistaken. The Commerce Department will release the fourth quarter results of 2018. So we'll stay tuned to see if it comes in closer to this newly revised 1.4 or if we're closer to the 2.7. Of course, the Trump White House is going to say it's still going to be the 2.7 or 3%, but I don't think we're going to get anywhere close to that, especially not this year. You still had a lot of stimulatory effect this year from the tax cuts, even still from the Federal Reserve, and a whole bunch of different financial engineering and a whole bunch of other things going on. Deregulation. But these stimulatory effects are going to start to dwindle. So if we're at 1.4% at the end of 2018, that is not going to bode well for 2019 and beyond until there's some structural change. So it's going to get interesting. It's going to get interesting for sure. Then in other news, we have the following. The National Association of Realtors said existing home sales unexpectedly fell 1.2% in January, marking a third straight month of declines. Now, I don't know why this is unexpected to them. If you've been listening to this podcast, you know that you shouldn't be surprised when it's a negative number going forward. You just should not be surprised, especially the fact that this is the third straight month of decline. So that's how it's been trending over the prior two. So how they're surprised, I don't know. Do they want it to go down? No, of course they don't. But that's reality. That's how markets work. They go up, they go down. Again, they're trying to find equilibrium. They're trying to find fair value. Let them undergo this process. Let them find fair value. Is there going to be some pain in the process for a lot of people? Yeah, there will be. But a lot of people on the other side can benefit too. People who may not be able to afford a house now, if their housing prices go down, well, now they can afford a house. It's just how it works. It's the ebbs and flows. It's the ebbs and flows. Continuing to put a Band-Aid on a bullet wound is not going to do anybody any favors. Continuing to tell the person who does the drugs, the drinking, the smoking, not exercising, yeah, just go ahead and keep doing that is not good medicine. So to keep money printing, to keep on with fiscal irresponsibility, it's not good practice. Then lastly, we have the leading economic indicators, which is a fairly good barometer of predicting expansion or contraction and is typically a good indicator for predicting recessions, dropped month over month. But again, because of the government shutdown, there has not been a complete set of data that the leading economic indicators looks at. So we're still missing some things. I believe the organization is going to put out an interim report on March 4th after the government releases some other data. So then we'll have a fuller picture as to whether or not their estimates were correct and it was a decrease month over month, or perhaps we may surprise to the upside and things are still looking up. What do I think is going to happen? Well, I think you know. So with that said, thanks for joining me today. Please share, like, subscribe. Check us out on thecapitalnews.com. Thecapitalnews.com. Of course, that's capital with a K. Leave your comments. We'd love to hear from you. Let's make it interactive. We'll catch you next time. This is The Capital News. I am Alex Koritis. Godspeed.